I'm Adam Myers and I lead the distribution team at Pengana. As our long-term supporters will know, we typically hold webinar updates for each of our funds twice a year, but we can obviously communicate in this way more often if we believe that we have important messages to share. We think that at the moment that's definitely the case because we're at a very interesting point in the economic cycle, and a whole bunch of factors have combined to create a compelling opportunity for the Pengana Global Small Companies Fund. So thank you very much for joining us this morning. This is a short webinar. We won't take more than half an hour of your time. John, the Chicago-based portfolio manager, will speak for approximately 20 minutes, and then we'll have 10 minutes for Q&A at the end. Please enter your questions in the question box accessed from the icon on your screen. John, over to you.
Thanks so much, Adam. Thank you for the introduction, and I appreciate all of you joining me today to talk about the Pengana Global Small Companies Fund and some of the opportunities we see out in the market right now that we think make it a particularly interesting time to look at the fund. I'd like to just take 1 second for those of you who don't know me to introduce myself. My name is John Moog. I'm the CIO and portfolio manager here at Lizard Investors. Lizard manages the Global Small Companies Fund for Pengana and has since inception. It's an experienced team. We've been together since 2008, focused on the international small cap space. We have a value-based biased philosophy, but really the core of what we do is investing in high quality businesses that we think are under the typical institutional radar screen. We're cash flow based investors, and we invest with a 3 to 5 year horizon. And for those of you who have listened to me before, I think will know, but and I just want to give a brief overview of what it is we do, which is really invest in high quality businesses and allow them to compound value for us over time. But what I really want to talk about today are what is the current market environment, what we are seeing out there, and then why we think it creates a really compelling opportunity for our strategy specifically. Again, our strategy has not changed in the last 12, 13 years since we started Lizard, but we think there's some factors that are starting to really come together that really benefit our strategy. So I'll start with where we sit today, and I think we're sitting in a pretty interesting place. Currently, the market feels very bifurcated to us. We have seen, the growth index, let's say that the chart here shows the growth index relative to the value index, and this is a global worldwide index, shows that growth has really outperformed value, especially since 2019. And we've really seen a blowout in that performance, something that we historically haven't seen. And what we really think it's created is this very expensive layer of growth companies at the very high end of the market. So piece of the market that is just very expensive, similar to what we saw kind of in the late 90s, early 2000s with certain sectors in tech. Lying underneath that, though, we think there is a very compelling set of opportunities that are attractively valued, a bit out of favor, given that so much capital has flowed into so few segments of the market. And much like in the late 90s, let's say the 2001 through 2003 period, if you were invested in, let's say, from a U.S. perspective, the Nasdaq, you absolutely got hammered as that segment of the market came back down to reality. However, outside of that segment of the market, there was a broad swath of companies that performed really well, and I'd argue most of the many investors who kind of value investors performed really well in that 01 to 03 period, compounding really nicely. And we think we're setting up for something like that moving in this period here, given where the market is at and given some of the things we're starting to see tactically change in the market. The first thing we're seeing is, obviously we are exiting a period post the COVID period. And this COVID period, I think, has really created an opportunity for really improved, let's say, an economic upturn in many parts of the world that is coming as economies open back up. We'd expect this to improve profitability across a pretty broad swath of companies and companies that we think, quite frankly, are valued at really attractive levels. So you're not only getting attractive valuations, but we think dramatically improved earnings over the next couple of years. We also think we're seeing a lot of inflationary warning signs. You're actually seeing inflation pretty hit in the U.S. Many are calling it transitory, but we're also starting to see, in our view, what could be a pretty protracted issue with shipping. The global shipping crisis, we think, is here and will exacerbate some of these inflationary pressures. We think these inflationary pressures really cause a lot of vulnerability in that really high growth, expensive end of the market I talked about. And so if we really start to see that catch hold, we think that high growth, really expensive end of the market, and I'd separate growth from expensive, but those pockets of stocks that have gotten externally expensive, we think are very prone to sell-offs if we do get into a more inflationary-like environment. And then I think the last thing we would point at is we really expect economic strength outside of the US to accelerate at a time where we think US economic growth should slow down a bit. And we think given the valuation disparity between the US and non-US, this creates another layer of opportunity for those investors who are positioned pretty heavily outside the US. And so here's kind of a little bit of supporting evidence of that. If you look at the international versus US equities, the dotted line here is kind of a neutral performance between US and non-US, and this is a rolling 10-year chart. But what you can see here is international has lagged US really dramatically since basically since the GFC. And we've seen this a couple times before. These are long cycles, but they do tend to mean revert. And we're in a position where international has really lagged for quite a long period of time. In our view, it has created a big valuation disparity and a potential catch-up situation for stocks and returns outside of the US. The other thing we are starting to see, and I think this is really interesting and critical, is that you've seen vaccine rates in the EU now surpass those in the US. So what really was a strong first half economic in the US, led a lot by the reopening of the economy and the vaccinations, is now flip-flopped, and you're starting to see Europe start to become really in a position to start opening up more aggressively. They're now leading in vaccines, and we think this is a nice setup for the EU to really experience a period of explosive economic growth coming out of the sort of COVID lockdown era. And here you can kind of see a little more supporting evidence of this. And here you see US hospitalizations starting to tick up while Europe remains under control as those vaccine rates really start to tick up. So from our perspective, and then secondly, you can see the Google activity index, if you will, you're really starting to see non-US countries start to tick up in terms of potential economic activity. And we think that is a precursor of what will be pretty meaningful economic growth here in the second half of the year for Europe. And the last piece of evidence here, I would just point to the GDP forecast, not only for for last year. You can see that a lot of countries obviously had economic contractions, but you can see, I think in the bottom of the chart, what you see here is private consumption growth. And we think that's really important for small cap stocks. You see in the US, we had really significant private consumption growth in 2021, largely in the first half. In the Euro area, you had bigger contraction in 2020. The first half of 2021 has been very weak. But here you can see in the bottom chart in 2022, you'd expect European consumption to actually outpace that of the US. And so as we expected European consumption to outpace that of the US, we would expect stronger economic growth and really laying the foundation for what should be a very attractive scenario for cheap European equities that are poised for a significant rebound in earnings. And just the last piece on the economy, here you can see real GDP growth for the second half, expectations for the second half of the year. You can see the US had a really strong first half with 7.7% growth, dropping to 5.6% growth. But in Europe, you're really flip-flopped and you're starting to, 3.1% growth in the first half, but really expectations are for very rapid growth in the second half, 9.5%. In the 13 years I've been investing all over the world, that is the fastest economic growth estimate I've seen for Europe. And you can also see ex-China, expectations for growth ex-China to really accelerate as well. And so not only do you have a setup for rapid economic growth that should lead to accelerating earnings of small caps outside of the US, you also have, and especially in Europe, you also are starting at a much cheaper valuation. And I know I've referenced that valuation a few times here, but what we think is really compelling is here on slide 11, this is the 24-month sector-adjusted price to earnings ratio. So this adjusts for all the sector and mix differences between US, non-US, Europe, Japan, and emerging markets. And what you can see here is almost everywhere in the world is trading at a 20 to 30% discount to the US from a valuation standpoint. So we think that is a really powerful to start with much more attractive valuations and what should be accelerating earnings growth that should lead to much faster earnings growth than what we're experiencing in the US, leads to a very interesting opportunity for small caps outside of the US, which is a market we're heavily invested in. And just, I think part of this is just who we are, given our expertise investing all over the world. But part of this is also the opportunity set we see and how attractive the opportunity set is. We're absolutely bottoms up oriented investors. But what our bottoms up process has really led us to is a really significant weighting in Europe and other countries outside of the US. And here you can see this chart, the regional exposure of our fund, which is predominantly non-US. So, a significant portion is Europe, a significant portion is countries outside of Europe, but outside of the US. And we have a pretty small weighting to the US versus the index, which is over half US. And so this is a really differentiated view, really driven by our bottoms up analysis. But and this has been fairly persistent in our investment process over time. But what gets us excited here is the fact that you now have a situation where the economic activity should really support this and potentially lead to it being a very favorable backdrop for this investment strategy, being so overweight Europe and the rest of the world. The second piece in our fund, again, bottoms up oriented, but we tend to be a little more interest rate sensitive than the index. And we think as inflationary warning signs start to tick up all over the world and central banks are forced to really come to grips with that, we do think we're well positioned in the eventuality that you see a more interest rate sensitive sector start to perform better as we see interest rates start to tick up as inflation starts to come through and central banks are forced to respond. So just to give you guys a reminder so obviously we really like the way the portfolio is positioned today. We're really excited about it. And just to give you guys a reminder of how it is we find stocks, and we are ultimately bottoms up investors, what it is we're looking for. This is just a reminder. We are looking for businesses with stable business models that are high returns on capital over long periods of time. We want businesses that have strong balance sheets that can fund themselves through downturns as well as fund their growth. One of the really nice pieces of investing in small caps is being able to invest alongside management teams that have a lot of skin in the game and are focused on compounding value over time and protecting our downside as well as theirs. The fourth thing we think about is corporate governance. And the fifth thing is a compelling valuation. And often how we think about it is wanting to be about half of what we think a business is worth on a 3 to 5 year basis and allow those businesses to compound for us. So I just want to give you a few examples of some of the opportunities we're seeing in the market today, and part of what gets us so excited and how it is we find stocks. So Soft Choice is a business we invested in May 2021, so a relatively new investment. And I think this fits in the category of really high quality companies that are sort of sitting under that very expensive end of the market, but are just very attractive opportunities with a lot of attractive attributes at attractive valuations. This is a business that it's an IT solutions provider. Some would call it a value-added reseller that sells software, hardware, and really meets all the software needs of their client base, which is largely in Canada and the US. It would be similar to a CDW for those of you who may know CDW here in the US. What we really like about this business, and this is a business we've had multiple investments in this industry in different places in the world. Both Softcat and Bytes in the UK were very successful investments for us, but you have very sticky customer base. You have naturally growing revenue, given the IT needs of customers, not only growing productivity needs, but security needs for mobility, needs for cloud. And what has happened here in this industry for us, which traditionally was a very fragmented industry, is you have a lot of consolidation as the vendors, more and more is being asked of the vendors. So those vendors are being forced to consolidate, and only the large players can really meet all the needs, the growing needs of their customer base. And so Softcat, while it IPO'd in Canada, was the largest player in Canada, but relatively misunderstood in the Canadian market, in our view, largely because they are the only business with this business model in Canada. But given our global perspective, we had seen this business model not only in the US, not only in the UK, and we were able to understand it. We made the investment, and it's been a very successful investment since the IPO. But again, what we love about this is, you know, in our space, these small companies that are growing 10, 20% a year with 40, 50% returns on capital, with management teams that own significant pieces of the business, and it's just misunderstood by the market. And we think now that now that you see some of this economic growth really start to drive some of these earnings, we do think these companies are going to really start to be recognized in the market. And much like you see Softcat get recognized pretty quickly after its IPO. In a similar way, you know, we have made an investment in Deliveroo in the UK. For those of you who know Deliveroo, and I know they operate in Australia, so you may be familiar with their service. It's a food delivery service. We really like this business. It's Amazon backed. The founder has a significant stake in the business. He's married to the business. This guy works 100 hours a week trying to grow the business. We really love their position, given that they have created a, let's say, omni-channel distribution for food. They not only deliver restaurants, but they also deliver from grocery stores. And it's really created the strongest logistical network, in our opinion, much like Amazon did in the early days for products. And so from our viewpoint, Deliveroo, again, a misunderstood IPO. The stock sold off hard after the IPO. But what we thought, you know, what we really liked about it is it's a strong franchise that we think can grow for a very long period of time with very high returns. And again, just operating in a space that was a little underappreciated by the market, given where it was trading. And we think that is starting to reverse. The stock has had a nice run. It sold off a little, but we think this is just the beginning of what is a really nice long run for the company. And what we're so excited about is this layer of very attractive businesses under that most expensive end of the market. Countryside, very similarly, is a UK home builder. They specialize in the partnership model, private-public partnerships. And so they really build entire communities in the UK. The attributes of this business that got us really excited, this is a business where UK is structurally underhoused. So there is a big housing shortage. These guys are the only player that really partner with small municipalities in the UK to build out these communities. And so they operate at a scale that no other home builder can operate at. The returns on capital in this business are over 50%, which is unheard of for a home builder, with very little front-end risk in terms of acquiring property to build on. And this is a management team that's created a massive competitive advantage and has significant growth ahead of it. We think this is a business that can grow at 15 to 20% for a very long period of time, trading at 12 times earnings when we made the investment. And so again, home building, not the sexiest space, but given the way this bifurcation in the market, we're able to acquire what we think is a really excellent business with significant growth that we think will eventually be valued at a much higher multiple given the return on capital. But again, I think that is what's so exciting about the space we're operating in right now and the opportunity set. You're just able to find opportunity like this after opportunity like this. And our pipeline is really full of what we think are just very high quality businesses trading at market multiples and just being ignored by the market because they aren't really getting that capital flow from that very expensive end of the market. You know, here you can see our performance over time. You know, I think, you know, we feel like we've faced headwinds for the last 3 or 4 years, given stylistically the US outperforming, us being underweight the US, growth really outperforming, and us being more value-based managers. But despite that, you can see since inception, 5-year, 3-year, 1-year, 3-month, performance has been strong. We've outperformed the market, and we really feel like our strategy performs well in almost any market environment, but we're particularly poised for strong performance on a relative basis, given where the market sits today on a go-forward basis. Here are our top holdings. We've already talked about 3 of them: Countryside, Deliveroo, and Soft Choice. Both Brenntag and TFI, similarly, a Canadian and a German business. Industrial businesses, one is a logistics business, one is a chemicals distribution business. Very high quality businesses trading at very attractive multiples, have been very successful investments for us, as you have just management teams that have compounded a lot of value, but you're not starting off with very high valuations. And when you can get that formula to work, it works out really well. And that we really feel like our portfolio is just full of those opportunities right now. So in summary, you know, we have an experienced team. operating with a proven strategy and what we think is an alpha-rich market niche. We think the catalysts here to drive the fund and the international small cap space are in place, and it's something we're really excited about. And we think our portfolio is well positioned to capture that on a go-forward basis. So, the team continues to be excited. I continue to be excited, and that is really a summary, and that's where I'll leave it. We'll open it up to Q&A, but hopefully that was helpful for everyone. And I just want to say I want to thank everyone for their time today, and hope everyone learned a little bit and got something out of the talk.
Thanks very much, John. I think that was very comprehensive. This wasn't actually the first question, but I think it's the key question, and it kind of reflects a few other questions as well. So I'm going to ask it first. What if we simply revert to the environment that we have all gotten used to over the last few years, with no inflation and bigger US-centric growth companies continuing to outperform?
Yeah, I mean, I think what we have seen, I think if that were to play out, I think the environment was similar to what we've experienced the last 3 to 5 years. I think you've seen the fund deliver, and I'll just flip back to our performance, on a 3-year, in a 5-year, and I would say, 3 to 5 years is a good time period in terms of the headwinds we've been facing. From our viewpoint, if they continue, I think we've seen the fund has compounded really nicely in those environments. We've continued to outperform the index. And so I think we'd be comfortable that we would still be able to deliver very solid performance in that environment. We just think the catalysts are in place that could really even improve the situation we're in. So we have no concerns that the portfolio, we've made, concerns about the portfolio performing well in that eventuality. We just think there are catalysts forming that really would benefit our strategy relative to what we've experienced that last 3 to 5 years.
Great. Thank you, John. Do you have any observations regarding the return of international travel in the Northern Hemisphere, and where are value opportunities presenting themselves in the sector?
So the first question is what's happening to international travel in the Northern Hemisphere. My sense is, you're seeing governments play a little bit of tit for tat. So if I take Europe as a block, right, I'd expect travel within Europe to start to accelerate here in the back half of the year. So let's call it intra-Europe travel should accelerate. I think intercontinental travel is going to be another 6 months, maybe a year, before we really start to see things back. I would expect it to kind of pick up slowly over time. And I think people will go from the US to islands for vacation or Mexico to vacation. Business travel going abroad, I still think we're a little ways off from that. We have our first live management roadshow coming through in 2 weeks. It's probably the first time I've seen a management come through from outside the US since January 2020. So, I think there's signs of life, but it's still slow. And the second part of the question is what I was a little confused about the sector.
Basically, within that sector, given your views on the opening up of travel within that sector, do you see any opportunities?
Yeah, we do. We think travel is one of a really interesting space right now. We don't have a massive weighting to travel, but we do have a few investments in the travel space. We have so one of the positions we've invested in is a ferry company that operates ferries between Ireland and the UK. Management owns 25% of the company, has been running the company for 25 years, and have been very good allocators of capital, especially in a contrarian market. And we've been in that market. And so management has actually invested in their fleet pretty dramatically in the downturn. We think earnings power of the business is probably 50 to 60% higher than it was entering the downturn. They've got very high returns on capital, have monopoly-like or duopoly-like positions in the market they operate in. And we're just starting to see the return of passengers onto ferries between Ireland and the UK. And we think that's one of the easiest first places travel comes back. We're not betting on international travel. Similarly, we have a position in a UK short haul vacation travel, online vacation travel business. We think that business will start coming back pretty dramatically. Europe missed the summer season a little bit this year by being a little bit closed down, but we think by next year it'll be a thing of the past, and people will be flying from the UK to Portugal, or from Denmark to Spain, or whatever it might be. And so we're excited about that business as well. And then the third business, we have a smaller position in Wizz Air, which is a long-time holding for us, which is a Eastern European low-cost airline similar to Ryanair. So we think all three businesses have great balance sheets, are poised for significant rebounds in earnings. And our view would be, we're not going to make a massive bet on, given with the Delta variant, we're not going to make a massive bet on travel. But we think that when you look at kind of normalized valuations with what is a likely path to return to travel, we think there's some very compelling opportunities.
Great, thank you. Next question. China's growth has slowed and they've been clamping down on their tech businesses. Do either of these factors pose a risk for your strategy?
So China is something we've been investing in for a long period of time. For those of you who don't know, my partner David is Chinese and moved to the US, I guess, when he was 15, but grew up in China. And, our view on China has always been a bit cautious. And so if you remember, one of the things we think about is corporate governance, and when we talk about China, we always think about how much is in a company's control when you're operating in China. And obviously the government controls more. So de facto, the companies control less. And so for us, we've always approached China with having smaller position sizes, probably being a bit underweight the index on average in China, and just as a default to having those smaller positions and being a little more wary. From our viewpoint, I think we don't think this is the end of the stock market in China. I think that China is really, a strong capital market benefits China in a lot of ways, and I think the government understands that. But if you look at kind of the sectors they crack down on, large tech, they want to control information, education, they want to control education. These are all fairly predictable things. We didn't have any positions directly impacted by any of the Chinese issues. However, I think from our viewpoint, it just reinforces somewhat of a cautious stance on China, given the fact that you have to be very aware of where the government sits. And I think this is really true in almost any country. You never want to bet, you never want to make an investment for a company that is going against the government. It usually ends poorly. And I think that's even more true in China, and we'll continue to approach it that way. We think China will have many opportunities. The technology in China is really fantastic. I think you just have to be really smart about what situations the government's going to be sensitive to, and making sure you're really far away from that, and then controlling it a bit with position size.
Great, thank you. And just to clarify, David is John's business partner, the deputy portfolio manager of the fund. Last question, because we are running out of time. Are there any US companies that derive revenue from Europe that you think could also benefit from this consumer-led growth in Europe?
Yes. There certainly are quite a few. You could look at the big guys, right? There are plenty of companies in the S&P 500 that derive revenue and profitability from Europe. That said, I think in the small cap space, what you have are, what I would argue, the more consumer-led companies tend to be more domestic-oriented companies. And so I think the direct participation in this will likely be more at-home companies, right? So companies that can service customers in market that, and you have some consumer-led product companies that will benefit, but my sense is, you have a much, I would rather start at a more direct beneficiary with a much cheaper valuation than I would with a kind of a tangential beneficiary and a much more expensive valuation. So there are certainly companies in the US that will benefit. But I think when we really think about a direct beneficiary, we want to be more local in those markets, and the small caps that serve those consumers in a local way are oftentimes, there are not many retailers that translate from the US to Europe, right? Most of the retailers are European retailers. And that's generally true across many aspects of the consumer spectrum as you look at Europe and other places in the world.
Makes sense. Thank you very much, John. Unfortunately, we have run out of time. There are a bunch of questions we didn't get to, but we'll respond to those directly. Thank you very much for joining us today. John has shared sort of a number of different facts and figures that we consider important context to understand the current economic opportunity. But really, our key message is that if investments in high quality, reasonably priced companies with economic tailwinds are rewarded, then our investors are likely to reap those rewards. So again, thank you very much. Please get in touch with us if you'd like to chat more about the fund or this opportunity. Enjoy the rest of your day.